Hey, what's up, you guys? In this video, I'm going to be showing you how to use your current home's equity to buy either a second home or a vacation home, or if you want to start building a portfolio of rental properties, whether you want to do long-term rental, get some passive income, or if you want to do something like Airbnb, Vrbo, or the short-term rental websites. All right, so the first method where you can draw money from your equity is by doing a cash-out refinance. And a cash-out refinance is probably the most popular, the easiest way to understand getting money from your equity. So basically what you're doing is that you are taking out a new mortgage that's going to be paying off the current mortgage that you have. If you already have a mortgage, you can also do this on a house that's free and clear. And this new loan is going to help you get some additional money that you need for your cash out. So for instance, say that your home is worth $500,000 right now and you owe $300,000 on your current mortgage. Now you want to get some additional money, and most banks will let you get up to 80% loan to value, meaning that you can get a mortgage up to $400,000. That's basically 80% of $500,000. So if you owe $300,000, the bank is going to help you get a mortgage up to $400,000. So that difference of $100,000 is going to be your cash out. Hopefully that makes sense. Now, the benefits of doing something like this is because you just get to keep one mortgage. So there are no second mortgages. There's no additional payments or anything like that. It's just one mortgage only, one interest rate. You can have a fixed interest rate right now in 2021. Fixed interest rates sort of make the most sense out of like any sort of conventional FHA loans. And basically that's what you're doing, okay? Some of the downsides of doing something like this is the fact that obviously you just took out one big loan, all right? And if you already had a pretty good first mortgage, then just by getting another mortgage that's not gonna have, either better interest rates or some sort of benefit, then you're going to be losing the benefits that you already have or some of the advantages that you have on your present mortgage. Now, one of the really cool things about doing the cash out refinance is that you can just sort of like rework a mortgage that doesn't have a lot of advantages. So for instance, say that you're paying too much of an interest rate on the current mortgage right now, or you're paying like maybe private mortgage insurance, PMI, mortgage insurance premium, you have an FHA loan, and now you can qualify for a conventional loan, then this new mortgage can actually help you sort of restructure that loan, get rid of it, and now you get a much better mortgage. Second way where you can draw money from your equity is by doing a home equity line of credit or a home equity loan. And really the difference between the two is that the HELOC or the home equity line of credit is a revolving line. So just sort of think about it as a credit card that you can use, pay it, use it again and pay it, and use it and just make minimum payments if you need. And whereas the home equity loan is like literally just one installment loan, all right? So if you take a home equity loan of $40,000, you just pay on $40,000. There's no ability to draw and use and pay it off and use as you need to. Now, between the two, honestly, I prefer the HELOC better because it gives you a few more advantageous options and obviously just the ability to draw as you need, where the home equity loan doesn't. Now, with the HELOC, guys, you can take out more equity than what you could with a cash out refinance. So where cash out refinance, they limit you up to 80% loan to value. With a HELOC, you can sometimes even go up to 95% combined loan to value. So if you have a mortgage of $300,000 right now, you can literally get a new home equity line of credit, $175,000 from your equity whenever you need. Now, I'll be really careful with this, guys. I wouldn't necessarily want to max out how much I can get from the HELOC because, you're basically taking out a lot of equity from your home. And if the real estate market dips, then you might find yourself underwater and the bank can actually cut your home equity line of credit anytime they want. So you want to be careful with something like this. But definitely the HELOC will help you get more equity from the cash out refinance. All right, so now that I've talked to you about the two different ways to draw money from your equity, just want to talk a little bit about what would be the best options for you. Now, with the cash out refinance, I would say that is definitely for those who are looking to be a little bit more risk adverse. You get just to have one mortgage. It could be a conventional loan. It could be an FHA loan. It could be a VA loan. And this just one mortgage is going to have one interest rate, and it could be a fixed interest rate. It could be an adjustable, whatever you want. But if you're looking to be more risk adverse, this would be the best option for you because you're just going to keep one mortgage only with one monthly payment. You won't have to worry about the payment going up or the interest rate going up or anything like that. So as long as you choose to do a fixed interest rate. Now, for those who are looking to just maybe getting some equity from their homes, and you just don't want to mess with your current mortgage right now. Maybe you got an excellent interest rate on your current mortgage and you just don't want to lose that interest rate, but you still want to have the ability to draw money from your equity. Then look into doing a home equity line of credit, because you are going to be able to keep that current mortgage and you're just going to take the HELOC and put it as a second mortgage, and you can do whatever you want with it. Now with the HELOC, it's basically sort of a tool to use money on a short-term basis. That's something that you want to pay off as quickly as possible, because HELOCs are adjustable interest rate loan programs, and when rates go up, the HELOC interest rate will go up as well. And also, one thing that you definitely want to know when it comes to HELOCs is that HELOCs only require an interest-only payment. So make sure that you're not just paying the minimum interest-only payment, because you will pretty much find yourself in a pretty bad spot after 10 years. So most HELOCs, have a draw period of 10 years where you can use it and pay and use it for 10 years. But if you're only paying interest only on those 10 years, then you're just going to find yourself owing a big amount of money that the lender now is going to increase a huge monthly payment, because now you have to, start paying some of the principal. So you want to be careful about some of those things. But the HELOCs are just great programs to help you get money from your equity without having to mess with your current mortgage. And that's it, you guys. Hopefully this video was helpful to you to understand how you can draw money from your equity. If you have any questions, put them in the comment box below. If you have any comments about it or just anything, put them in the comment box below. Also, if you like the video, make sure you give it a like, subscribe to the channel, share it with anybody you think that will also get some benefit from doing something like this. And I will see you guys in the next video. Thank you for watching.